Hello, it's Angie. I hope you're all keeping well. Now today, I want to give you the 4 main things that can trigger questions from HMRC, and to understand that HMRC can see more than most people realise these days. Imagine opening a brown HMRC envelope and reading, "We need more information." Immediately your stomach tightens. You haven't hidden anything. You haven't tried to avoid tax. You haven't done anything dishonest. So why are they writing to you? More importantly, how did they know? And that question surprises many people, because most of us still think HMRC only sees what we put on a tax return. But in reality, HMRC receives information from a wide range of sources every year, from employers, pension providers, banks, building societies, investment companies, and property records. And on top of that, HMRC has a data matching system called Connect, which helps compare information from different sources. Now, before anybody panics, this is not about HMRC spying on people, and it certainly does not mean that receiving a letter means you've done something wrong. In fact, many honest pensioners receive HMRC letters every year simply because something doesn't appear to add up. Today, I want to show you 4 situations that can cause HMRC to ask questions about your finances, how HMRC may become aware of them, and what you can do to protect yourself. Drawing on more than 25 years of experience in accounting and public finance, I'll also explain it in plain English. Let's begin. Let's first look at how HMRC Connect works. So before we look at the 4 examples, let's understand the basics. Imagine a giant jigsaw puzzle. One piece comes from your employer, another comes from your pension provider, another from your bank, another from an investment platform, and another may come from property records. Now, HMRC's Connect system helps bring those pieces together. And as I explained, the purpose is not to accuse people of wrongdoing. The purpose is to identify situations where information appears inconsistent. For example, one source says one thing and another source says something different. Or information arrives that does not appear to fit the overall picture. That is often when questions begin. And the first example is probably the most common, and that is the £20,000 that appeared overnight. Let's imagine Margaret. Margaret receives the full new state pension in 2026-27 of approximately £12,547.60 a year. She also receives a private pension of £6,000 a year, so her total taxable income is £18,547.60. Then one day £20,000 arrives in her bank account. Margaret isn't worried. The money came from selling her caravan. Everything is legitimate. The problem is that HMRC doesn't automatically know the story behind the transaction. All they may eventually see is income around £18,500, additional money appearing elsewhere. At that point, they may simply ask, where did the £20,000 come from? The answer is easy. She sold her caravan, but only if she kept the paperwork. That is why records matter. Because years later, memory fades, paperwork doesn't. Let's move on to number 2. When your spending looks higher than your income. Now this one creates a lot of misunderstanding. Imagine John and Susan. Together they report modest retirement income. Then they replace their kitchen, buy a newer car, take several holidays. Nothing wrong with that. But where did the money come from? In their case, the answer is simple. They spent savings accumulated over 40 years. Perfectly legitimate. But if HMRC ever asks, they need to be able to demonstrate that. Remember, HMRC is not interested in whether you own a nice car. HMRC is interested in understanding the source of funds. Savings, inheritance, investment sale, pension lump sum, those are all valid explanations. The key is having evidence. Let's move on to number 3. The return that's always late. Let's move away from pensioners and look at anyone completing self-assessment. Meet Susan. Year 1, she's late with her self-assessment return. Year 2, she's late again. Year 3, late yet again. Then amended, and then amended again. Has Susan committed fraud? Absolutely not. But repeated lateness suggests poor record keeping to HMRC, and poor record keeping creates mistakes. The easiest solution, do keep records throughout the year. Don't leave everything until January. A few minutes each month is much easier than a stressful weekend trying to reconstruct an entire year's finances. And the last one that I want to talk about today is number 4, claims that stand out. Imagine 2 self-employed gardeners. Each earns £30,000. One claims £4,000 of expenses. The other claims £18,000. Perhaps the larger claim is completely legitimate. Perhaps expensive machinery was bought. Perhaps there were unusual costs. But naturally, the claim stands out. You see, HMRC receives millions of returns. That means it can compare patterns across industries. Again, standing out is not wrongdoing, but standing out can and often will now trigger questions. And the lesson? Claim everything you're entitled to, but keep every receipt and every invoice. Let's talk about what the biggest HMRC myth is, and that is an HMRC letter means you're in trouble, because most of the time that simply is not true. Many letters are requests for clarification. Many are resolved quickly. Many involve nothing more than explaining something that already has a perfectly innocent explanation. And the worst thing you can do is panic. Second worst thing you can do is to ignore it. So there are 4 things to remember. If you remember nothing else from today's video, remember these 4 points. 1. Keep evidence of large transactions. 2. Keep evidence of gifts, inheritances and asset sales. 3. File information on time. And 4. Keep records supporting anything you claim. Because these 4 habits solve an astonishing number of HMRC problems before they ever start. And here's a final thought. HMRC systems have become increasingly sophisticated and complex, but the solution still remains surprisingly simple. Keep good records, be well organised, and be able to explain where your money comes from, because most HMRC inquiries do not begin with fraud, they begin with confusion. And the easier you make it to explain your finances, the less stressful those conversations are likely to be. Please remember that I do not provide personal financial advice. It is based on tax and pension rules and public guidance for the 2026-27 tax year, so bang up to date. But remember, individual circumstances vary and rules can change. As you can see, we do live in a changing world, and my objective is to keep you informed of all those changes that are now happening every day. So I hope you'll subscribe and share and like this video to be sure to receive my future videos. This is Angie, and all that remains is to wish you a very good day, and it's goodbye for now.